Redburn Atlantic downgrading the tech giant to neutral from buy this morning, citing little room for upside over the next few years. KeyBank also issuing a warning to investors, saying to expect below average growth for the first quarter. So these are just the latest firms making calls on Apple after Barclays and Piper Sandler both downgraded the stock last week. Our next guest is optimistic that Apple has bottomed out, and there's only upside from here. Mark Newton, Fundstrat Managing Director, joins us now. I mean, there's been so much proliferation of a buy on the dip mentality that has emerged over the past couple months here. And so for Apple, is that what you're believing could be at play?
Well, look, I think 2024 has started off not unlike many years in that we've seen some real mean reversion where the former leaders of the past year are now laggards and vice versa. So technology, consumer discretionary, industrials have all underperformed in recent weeks. Meanwhile, you see areas like healthcare, which have really started to show some outperformance. My thinking is Apple has not shown sufficient deterioration to really warrant any sort of technical concern in the near term. I mean, the stock has had a pretty lengthy short-term decline, but in the bigger picture, the stock largely is still in very good shape technically. I think the bad news has gotten a bit ahead of itself, and the stock likely is starting to stabilize. That's a good thing. Technology, to its credit, has not broken larger uptrends versus the S&P. So when you look, is tech still attractive? The answer, technically at least from my perspective, is still yes.
And when you take into account the fact that you see, at least technically speaking, that tech is still attractive, when investors are trying to figure out what that upside looks like, what are the technicals telling you there?
Well, in the short run, we've had a very big move in a short period of time. So it's been from October, markets have been up literally 20% or so in about a 2.5-month period. So it's normal to get this sort of New Year's hangover where markets consolidate a little bit. My thinking is the upside near term is probably near 4,900, whereas the downside is going to be capped at 4,600. Now, I've taken some studies of election year seasonality. Normally, the first quarter is not all that robust, and typically we tend to see some underperformance. So it's not surprising to me, specifically given how rapidly sentiment has gotten more optimistic. I mean, the market has gotten accustomed to thinking, well, there's all these rate cuts now that have been built in, whereas the data, meanwhile, has been pretty resilient. So if anything, it's a period of just consolidation. I don't think that's negative. The bigger takeaway is that, the improvement in many of these underperforming sectors is going to be a big positive to investors for 2024. If anything, this is going to be an easier year to make money in than last year, where it was largely technology driven up until about October, and then everything started to kick in. That kicking in is actually a very big positive for the year as a whole. My year-end target is 51.75, so it's about 10% upside from here. I think it's going to be a choppy first quarter, but I see the fact that people are still very, very negative. $6 trillion in cash on the sidelines. We have two wars. People are concerned about inflation. It's an election year. There's a lot of things to be worried about. That's normally a very good sign for risk assets and markets.
And so for those out there who are trying to figure out where the best opportunity for them to, even amid some of the events that could create and drive more volatility, trying to best position themselves in areas that might look oversold right now technically, where are some of those areas that might seem nonsensically oversold?
Well, specifically on a stock level, and I look at markets completely different than that. I don't look at mean reversion as always being something you want to grab to and jump on the stocks that have gotten the most oversold, thinking that's the best buying opportunity. China, case in point, has been a very difficult market to buy. Yeah. Small caps started off fairly good, and now they started to be given back. I would look at companies like PayPal, Zoom, for example. Those stocks have come down substantially. And honestly, it's still very difficult to try to buy the dips in companies and stocks like that. But I think if you're patient, then you can be rewarded once they start to show evidence of technical strength, and the fundamentals will start to reaccelerate.
Mark, I want to ask you, and I think we have a chart ready for you here on Boeing. Boeing, one of the top stories of the week. When we talk about some of the price action that we've seen, yes, we are off the lows of where we did start the week, but is there still reason to believe there might be some more downside pressure to this name?
Well, the stock has, unfortunately, over the last couple of years, has had more of a 2 steps forward, 1 step back type trajectory. As soon as the stock starts to rally, we see unfortunate news, and the stock is sold off. I tend to like the space. I think industrials are one of the top areas for investors to consider. The industrial sector rose to almost 2 decade highs versus the S&P. Boeing I don't think has much more than probably 5 to 10% downside, which sounds like a lot, but in the bigger scheme of things, it has gotten short-term oversold. I think there's a lot of bad news now in the name. Everybody's talking negative. I think normally that's a time when you want to, avoid that news and look to buy dips.
And so for the dip buying mentality, which it's seemingly come full circle here, both whether that be with Apple, whether that be with Boeing, where else in the market are you seeing across asset types, perhaps some of those dips that look most attractive?
Well, I generally avoid the defensive sectors. Those have been so hard hit. So I am not really in favor of consumer staples, utilities, REITs. Those are areas which have tried to rally but have gotten very overdone in the near term. I would look towards sectors like healthcare, which was a huge underperformer last year and has now really started to come back. Granted, some of the vaccine makers like Moderna and Pfizer are still under a lot of pressure, but I think that still is an area that makes sense for investors for this year. Biotechnology specifically, a lot of great growth companies within that group that have lagged and are now starting to come back to life.
All right, so despite all the risk and all the uncertainty out there, still looks like it's a good setup for investors this year. Mark Newton, always great to have you. Thanks so much for coming in here in studio. Fundstrat Managing Director.